investors now are starting to realize that they need to hold gold and silver as opposed to U.S. Treasuries. And so now $5,000 gold isn't anywhere near where this is going. I mean, I don't really know at this point whether it's 20,000 or whether it's higher than that, but the bar has been moved substantially over the last dozen or so years based on all the money we've printed, all the debt we've accumulated.
Gold is going to go a lot higher. I can easily see it going to $10,000, but that's not even a stretch. That's pretty straightforward. $25,000 or higher. I'm not forecasting this. I'm just saying it happened. And if it happened again, gold would be $100,000 an ounce. When gold goes from $35 an ounce to $800 an ounce, which it did, you can say, oh, the price of gold went up.
Renowned economist Peter Schiff is urging investors to exit the U.S. dollar before the majority realizes the risk. Calling the dollar the real danger, Schiff points to gold and silver as the true safe haven assets amid accelerating currency debasement, with gold already approaching record levels and projections reaching $10,000, $20,000 per ounce. Even fractional gold could represent significant purchasing power. Schiff also warns of looming silver shortages driven by rising physical demand and limited supply. As awareness spreads, he believes precious metals will become increasingly scarce and expensive. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold is going to go a lot higher. And I get a form of that question a lot, Julia, because people say, hey, Jim, you said to buy gold when it was 1,200 or 1,300. I should have listened to you. I didn't. It's getting close to 5,000. I missed the boat. And my answer is, no, you missed $3,000 or $4,000, but you didn't miss the boat. This has much further to run. And it's not a top. It's nowhere near a top. And it's going to go, well, I can easily see it going to $10,000, but that's not even a stretch. That's pretty straightforward. $25,000 or higher. Yes. But let me give you some concrete, math and analysis behind that. Cause anybody can throw out a big number, and they're out there, they're on podcasts or whatever. It's gold, 25,000. But you need to know why. And, there are a couple things in play here. Number one, in January 1971, gold was $35 an ounce. In January 1980, it was $800 an ounce. That's a 2,700% increase in 9 years. If that happened again, I'm not forecasting this. I'm just saying it happened. And if it happened again, gold would be $100,000 an ounce. When gold goes from $35 an ounce to $800 an ounce, which it did, you can say, oh, the price of gold went up. Yeah. But if you hold gold as your constant, in other words, what's the dollar worth by weight of gold? Don't ask what gold is worth in dollars. Ask what the dollar's worth by weight of gold. It's just the inverse. Okay. It's the same math. The answer is that was a 94% devaluation of the dollar. The dollar lost 94% of its value measured by weight of gold. And people today are looking around like, hey, the dollar's going to, it's the crack up of the dollar's going to collapse, et cetera. But they look at the currency market. That's not the right way to think about it because all those currencies are in the same boat. For example, what's the euro worth today? What's a euro worth in dollars? That's the question. The answer is about $1.16. So €1 equals $1.16. Guess what the euro was worth in the year 2000 when it was first issued? $1.16. In other words, it hasn't changed in 25 years. Now it's gone up and down. It was $1.60. It was 80 cents. It fluctuates. There's volatility. You can make or lose money. I'm not saying it's constant. It's not. But the fact is, there's no collapse of the dollar there. The euro dollar cross rate today is exactly where it was 25 years ago. That's not where you're going to see the collapse. It's not going to be in the currency market. It's going to be in the gold market. And so when people say the price of gold goes up, I get it. But, if you have a gold coin, you put it in a drawer and you close it and you go away for a year and you come back and you open the drawer, it's still a gold coin. It didn't multiply. It didn't do anything. The gold is the constant. It's the value of the dollar that's going down. Okay. So when the dollar price of gold goes up, the way I think about it, the U.S. dollar is collapsing. When did the dollar collapse? Well, in the 1970s, in gold, it lost about 94% of its value. If that happened again, I'm not saying it will, but if it does, gold would be $100,000 an ounce. So if I say $100,000 an ounce, people are like, Jim, you're crazy. What are you talking about? And my answer is it happened before.
Right.
Okay. Now, there's another phenomena, a little more down to earth, and we'll tap into behavioral psychology. Because in behavioral psychology, there's a big science, Daniel Kahneman and Tversky and Dan Ariely and a few other leaders in this field. And they've identified a whole list of biases. We're just human. We have biases. And instincts and we can't get rid of them, but it's good to know what they are. But one of them is called anchoring. And anchoring means we get a number in our head, we get an idea in our head, and we can't get rid of it. And we begin to filter everything we see through that idea. That affects everything we think. So as applied to gold. So let's just say you have 50 ounces of gold and it goes up $1,000 an ounce. You just made $50,000. I mean, that's real. It goes up another $1,000 an ounce. You just made another $50,000 and so on. Every time it goes up $1,000 an ounce, you made another $50,000. Well, but you kind of get anchored on the $1,000 jump and the 50 ounces and the $50,000. But what people lose sight of is that each $1,000 leap is easier than the one before, a lot easier. So, for example, when gold went from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. That's a heavy lift. And from 3,000 to 4,000, that's a 33% increase. That's still a big lift. Now we're at 5,000. But when you go from 9,000 to 10,000, that's only 11% because you're working off a much higher base.
What you mean, yeah.
And when you go from 19,000 to 20,000, that's only a little over 5%. So the point being, these $1,000 leaps get easier because you're working off a higher base. So what's going to happen? Gold's, it's made its way to 5,000, not quite there yet, but it'll be there, very shortly. And it's going to, take a while to get to 6, but it's going to go 7, 8, 9, 10 really fast for the reason.
Analysts argue that gold's breakout began in 2024, followed by silver in 2025, placing markets in the early stages of a multi-year precious metals bull run, with gold trading near fresh all-time highs above $4,900 and silver approaching $100. Experts warn prices may soon move beyond reach for late buyers. Despite sharp gains in 2025, mining stocks remain undervalued as earnings growth has outpaced share prices. As global demand shifts away from the U.S. dollar toward gold reserves, 2026 is shaping up to be an explosive year for metals and miners alike. Let's get back to the interview.
$100 silver, which we just broke through today for the first time ever, I think that's a much more significant milestone than when Bitcoin hit 100,000. Yet, there's no big silver $100 parties going on around the country. Nobody's really talking about it very much. And that's a pretty good indication that 100 is not the end. It's really the beginning. And silver is headed a lot higher. Gold, of course, is now about $30 away from 5,000. And if we don't hit it today, we'll probably hit it on Sunday night. When I first started predicting $5,000 gold publicly, it had, gone above 1,000. It was like 1,200, 1,500. Now, of course, I was making that prediction, 12, 13 years ago. And a lot of people, gave me a lot of shit because it didn't happen. Well, it's happened now. And sure, I made the forecast very prematurely. I didn't think back then that it would take this many years to get to 5,000. But the fact that it did take so long means that it's going a lot higher than 5,000, because I assumed when I first made that forecast that we would have a dollar crisis and it would cause that to happen, but it would also put the brakes on all the deficit spending and the quantitative easing. But none of that happened. And so we got away with doing it for another dozen years. And so now $5,000 gold isn't anywhere near where this is going. I mean, I don't really know at this point whether it's 20,000 or whether it's higher than that. But the bar has been moved substantially over the last dozen or so years based on all the money we've printed, all the debt we've accumulated. And, even if you bought gold, when I forecast it to go to 5,000. Even if you bought it back then, you still did better than if you stayed in the S&P. So it wasn't like my advice cost you money just because it took more years than I thought to get to 5,000. You still, tripled your money, which was better than you would have done over that same time period in the S&P. So it's not like it was bad advice. And of course, we're not done yet. Gold's not going to stop at 5,000. So the gains are just going to continue. And people who own gold and silver will continue to make more money than people who are just sitting in the U.S. stock market. And the dollar's days as the world's reserve currency are numbered. Right? The world has kind of made an informal decision to abandon the dollar. It started last year as central banks were accumulating gold. They're going to continue to accumulate gold. This year, more central banks are going to get in on it. And investors now are starting to realize that they need to hold gold and silver as opposed to U.S. treasuries. So the world is trading in their dollars and their treasuries for real money. And that is a game changer, especially for the United States. We've been living high on the hog with the exorbitant privilege of creating the world's reserve currency. That's enabled us to live beyond our means. That's kept consumer prices and interest rates lower than they otherwise would be. And it's allowed us to have this service sector, consumer-based economy. And it's allowed us to build up this massive Defense Department that Trump is bragging about. So I think what's going to be happening this year and next year is a major devaluation of the dollar relative to other currencies. That's going to lead to a significant increase in the cost of living in the United States. So the affordability crisis is going to be far more extreme.
Analysts argue that buying gold and silver at today's highs is not buying the top, but entering a long-term breakout that is still in its early stages. With limited pullbacks and massive capital waiting to move into precious metals, prices are expected to climb relentlessly. As confidence in U.S. Treasuries and dollar-denominated assets erodes, gold and silver are leading a broader shift into foreign assets, resources, and value investments. This accelerating exodus marks the beginning of the dollar's end as the global reserve currency. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.